Good morning, Amplified Traders. Testing, testing. If you can hear my voice and if you can see my trading screens in HotCom, please type Y. Good morning, good morning, good morning. Hello everybody, welcome. So here we are, 2nd of September. Pretty ugly start first thing yesterday on the market open. Things seem to have rebounded somewhat already this morning. Let's just have a review of yesterday by asset class then. As you are aware, the S&P, the DAX, major equity indices opened lower yesterday. Here we are for the September overnight session. So the S&P opening below 1934. We're just trying to get above that level now as the S&P approaches the highs of the session. The DAX gapped lower yesterday morning. We've gapped higher this morning. But here's that gap lower yesterday morning in the DAX. So we moved all the way from 10,227 all the way down to 99.48 throughout the day. But actually, in the end, what we saw yesterday was one that would have been perfect for range traders. Here I've got on my chart the 10,000 level. So that 10,000 level in the DAX that I mentioned, we'd crossed higher and crossed lower so many times it was reducing its importance as a significant technical level. But really what we had after opening and gapping lower and then rebounding more strongly, we had a perfect range day between S2, which came in at just 10,041, between S2 and 9,948, 9,938 odd, oscillating around this 10,000 handle. So actually yesterday, for the majority of yesterday, the market did not move anywhere in terms of equities. A sideways movement in equities here, but the ranges of this trend are quite phenomenal. It looks like this is just a sideways trend, but actually this is a 1.10% range in the DAX. So even just one contract buying the low, selling the high just once, that's €2,500 just once. And it happened twice, 3, 4, 5, 6, 7 times. So depending on what type of trader you are, you might have found yesterday's condition actually quite well suited to you. For somebody of more of an activist nature like me, the fact that you didn't actually end up going anywhere would have made yesterday quite difficult in equities. But that's just a picture in equities, relatively flat. We had poor US data, worse than expected US data. It didn't seem to matter too much. But this morning, if we watch the DAX, we've gapped back up above 10,000. We've torn through R1. And as China stabilizes overnight, we've got a very positive start to European equities. Keep your eye on this level now in the DAX. It's worth watching now. So 10,011.75. We've got the high that we hit yesterday morning. So can you see this is the level, the exact high that we hit yesterday, just after the market opened. So we're about to approach this gap fill. Can you see this gap fill on your charts? This might well be worth trading. Yeah, and P2P is just pointing it out. Can you guys see that on your charts? Watch the DAX, please. Can you see that gap? So this is the gap fill. Where is the bottom of the gap? Well, at the moment I've got, actually, it might be a relatively small gap fill. You've got the first target of this gap here at the low that we saw on Monday. So it's just a 10-point gap. Can you see that gap there, guys? If we do get above, let me make that ellipse slightly more heavy. If we do get above that level, then you could be looking at the low here, which was the low back on Friday as well. All the way up at 10.18.4. So a decent opportunity here in the DAX. If you're trading Euro stocks, or if you're trading the S&P, or if you're trading, well, anything that you think might be correlated to the German index, then watch this gap and see if you can then strategize on the Euro stocks should that gap be breached. Okay, that would be a sensible thing to do. So keep your eye on the DAX, please, as we do approach that gap. Well, oil, I'm going to go straight to oil in terms of yesterday's market action. I mean, this is just phenomenal what we're seeing in oil, isn't it? So as we opened yesterday, or today is Monday, sorry, so let's get to Tuesday. Yeah, this is yesterday. We're trading at $48 a barrel. We went almost to touch $50 a barrel. This is US WTI oil. So 3 strong days of gains, 25% in 3 days, the strongest 3-day rally for 25 years. That's where we found ourselves yesterday. What then happened? Well, Rabia, you'll be pleased you did take off your long oil trade in the end, because we then went all the way back down to $43.87. $43.87. So from the high that we hit, let's go to the currency tool. What type of percentage move is that? It's a 10% move. So we had a 10% move in oil yesterday, down, after a 25% move higher in 3 days. This is incredibly volatile market activity. I mean, I'm not going to say I haven't ever seen anything like this in the oil market. We have seen extensive volatility, but this is really making, well, it depends again what type of trader you are, but if you are able to take advantage of some of these opportunities, then this is absolutely great. Well, look at where we found support in oil, right on the support level that we also found on Monday. So that's at 43.85. And here I'm going to share an FT article. Oil bear bets on a return of $25 a barrel, one of the biggest bears in the oil market, has not been swayed by the snap rally. Well, by the time they wrote this, it was out of date. Has not been swayed by the snap rally that pushed oil up 25%. Pierre is saying down 20%. His justification for this, back to supply. We don't expect US production to go down much further, maybe another 200,000 barrels a day relative to today. That's not going to be enough to rebalance the market. Operating out of London's Knightsbridge, Harrods office, where most of his customers are oil producing nations, I'm sure. I don't know how you can make that type of claim on oil. I think a lot of these guys are, just looking for press time. Oil is going to be one of the hardest things to try and predict, but you could go down to 25, sure. But all it would take would be OPEC to take some action in some way, and then you can see the oil market rebalance, maybe around 60, maybe around 75, at least in the short term. And I don't think you can even begin to try and predict that kind of move. On the back of oil, though, and on the back of a slowing Chinese economy, this is an interesting chart overnight. This is, you want to type it in your CQG, DA6. DA6, this is the Australian dollar. And the Australian dollar against the US dollar has been absolutely hammered by this fallout in the commodity market and by this slowdown in China. There's further discussion on whether this China slowdown actually has a long way to go, and I'll show you that article as well in one moment. But have a look at the Aussie dollar here, guys. That's DA6 on your CQG platforms. This is one of the currencies that has, for a hedge fund manager, this type of trend is absolutely perfect. Consistent, all in one direction. The fundamentals continuing to support a weak Aussie dollar. We had GDP data out of Australia, worse than expected. The outlook for Australia is not looking great. And the Aussie dollar overnight did trade just below 70 cents. It was only a couple of years ago we were at parity with the US dollar. So this is a huge move in the Aussie dollar. And here in the FT, more discussion talking about China risks and economic discontinuity, and discussion here that actually the picture of Chinese data that we've had so far is a lot more positive than what the reality might be. Again, I would take this with a pinch of salt, guys. The media quite often do this, and this is why trends happen, right? Because you get the market pointing itself in one direction. Everybody's focusing on one piece of thought or one overriding driving factor, which is then that's what the journalists write about, that reinforces everybody's concern over that driving piece of data, and it can become self-fulfilling in a while. So here they're looking at the 3 reasons why Chinese growth might suffer a discontinuity. The current pattern is unsustainable, the debt overhang is large, and dealing with these challenges creates the risk of a sharp collapse in demand. The most important fact about China's current pattern of growth is it's dependent on investment as a source of supply and demand. Okay, so a huge drain in terms of funds for the investment to go into China to try and keep its growth at these levels, and it's just, according to this article, unsustainable. Okay, it's interesting though, isn't it? All of these articles come out now rather than before the correction in the Chinese equity market. You know, this data is going back quite a long time. It's going back to 2000, 2005, where they're showing this pattern of discontinuity in Chinese growth. It really is the Chinese equity market shock that's brought this to the forefront of everybody's attention. So we're having a strong day for the moment. We've just found resistance at that level in the DAX that I was talking about, that top from yesterday's high. Can you see where we've just found resistance? Unable to get through that level at the moment, but do keep an eye out on that level, of course. What have we got coming out today? Well, at 9 o'clock, just in 15 minutes time, we've got inflation data coming out of Europe, so producer price index. We've already had the Australian data, GDP, coming out. We were expecting, just to focus on this for a moment, we're expecting quarter on quarter GDP out of Australia at 0.4%. It came out at just 0.2%, half what was expected for Australian GDP quarter on quarter. There's a real fallout there from the Chinese story for sure. Here we have midday, we've got NBA mortgage applications, minor data coming out of the US. Let me just bring up the trading live page here. Producer price index coming out of Europe before that, so keep an eye on the euro, US dollar, of course. ADP employment change, this will be the main event for the day, I believe. So that's at 1:15. Make sure you're at your screens at 1:15, guys. The reason why this is absolutely significant is ADP is quite often used as a precursor to non-farm payrolls, which will be the heavyweight data release coming out on Friday at 1:30 London time. ADP can give us an idea of what non-farm payroll is likely to be. It's not overly reliable, but it can give an indication. So given the importance of this Friday's non-farm payrolls data, if ADP comes out much stronger than expected, consensus we've got 201,000. If ADP comes out much stronger than expected, then my goodness, are we going to see some movements? Okay, we're going to see some absolute colossal moves in the US dollar, because what's the percentage now for a September hike? It's about 20%. The probability for a September hike now? 22. 32% for a September hike still. So, you know, a September hike is still on a third chance of probability, September hike. So if this data, if ADP comes out much stronger than expected, then you really are going to see the dollar move. And I think that will be the clearest trade, any currency against the dollar. Okay. So ADP 115, non-farm productivity coming after that, 130, unit labour costs as well. That will be interesting actually. They're saying it's only minor, but that will be interesting from the point of view inflation. Also 2:45, 15 minutes after the cash market open, ISM New York index, factory orders at 3 o'clock. And then at 3:30, as normal for the Wednesday, we've got the oil data. Given our daily 10% swings in oil now, then that could be an interesting one to trade also. So we've got enough activity on the wires. The first up will be European PPI coming out in just over 10 minutes time, so keep an eye out for that, please. Emmanuel, you're asking about a head and shoulders on oil. It looks like it, doesn't it? We've got a decent pattern here on oil. If you are taking, well, we haven't got the other shoulder yet, but certainly if you are looking at that head and shoulders pattern, you've got one shoulder there. Let me just remove that currency valuation. We've got the head there, if you like. So you need to wait for this second shoulder to form, because it might not be at exactly kind of 46 or 49, 43. The second shoulder might be forming, for example, you know, sometimes you can get the second shoulder working on this type of line, can't you? So we have to, for confirmation of that, I'd like to see that second shoulder form. But for now, the neckline does look to be relatively secure. 43.91 odd for the neckline. If I just make that neckline slightly fatter for a Head and Shoulders and oil. Jim's saying that's when it's got a chip on its shoulder. Yeah, look, 10% moves in oil. This is such an opportunity for us, guys. This really is. You used to have to wait a month or so to get a 10% move in such a popular liquid asset class. So interesting times. And if you're trading oil, Rabia, you had an excellent trade yesterday. That was excellent to see. I'd like some more of that, please. And it's good to discuss these trades in the room, get everyone to think about what other people are thinking about. You don't have to copy people's ideas necessarily, not at all. That's not the point. But it just gives more information. How are other people looking at this market? Do I believe them? Is this what I want to do? Is this how I want to position myself? Well, you can choose to do something very differently, of course, but it's just interesting to know how other people are thinking. One other trade that I'm not in, but this definitely would have caught me out, by the way. We are now trading close to 2015 highs in the value of the euro versus the value of the pound. So we're now trading close to 2015 highs in the euro pound. I would absolutely not have positioned myself for this should I have been in a long-term trade in the pound versus the euro. Why? Well, very clearly, you've got monetary loosening in the Eurozone. You've got ECB QE 60 billion euros a month. And in the UK, what you really have is perhaps the first monetary policy hike might be in the UK rather than the USA. And certainly the UK is going to be, at the moment, the first country to raise interest rates should the US go before it. So they'll be the first one to follow the US, certainly. And so this euro push higher against the pound is that definitely would have caught me out. If I was running my long-term macro fund, this one would be beginning to turn the screw on. However, we are at these 2015 highs. Is this worth a long-term short on cable versus the pound? Yeah, that's a really tricky one. To me, that doesn't seem to be going along with fundamentals. Yeah, that doesn't seem to be going quite with fundamentals in my opinion. Why would the euro be up on the 2015 highs versus the pound? Well, one of the reasons, you know, there are reasons for this, but they're kind of, if you like, non-rational reasons. But one of the reasons is that if people believe that there is going to be no September hike, then what's the most popular currency to trade against the US dollar? It's the euro. So if you're getting out of long dollar positions, it's going short the euro versus the dollar, for example. I don't know. The euro is acting in quite an interesting way, really. I mean, a lot of people, I showed you Goldman Sachs' prediction at the beginning of 2015. Everybody was looking for parity, weren't they? By this date, how many investment banks were looking for parity in the euro versus the US dollar? About all of them. And they were telling you that when we were trading around these levels, 104, 105. So this is where the big predictions were coming. Euro US dollar to go down to parity by summer 2015, so by now. Whereas in fact, rather than being at parity, again in the euro versus the US dollar, we're trading on the highs of the year, pretty much. So the currency space is definitely a difficult one in terms of, being able to try and rationalize long-term trends. Let's see what happens with ADP data coming out today, because if the US production data or the US employment data is much better than expected, if we start to get US data that's much better than expected, then this move out of other currencies into the US dollar on expectation of Fed liftoff needs to take place again. It's undervalued. There's definitely an opportunity there, in my opinion. Okay. So that's it from the morning briefing, guys. Busy day ahead. We've got 9 minutes till the European PPIs, please. Month on month, I've just got consensus at minus 0.1. PPI year on year, minus 2.1. keep your eyes out on the euro on this, obviously. One thing I haven't covered actually is the Bund fixed income at all, or T-note. So let's have a look at the Bund this morning. Been a tricky couple of weeks in the Bund, but look at Monday on the Bund. And I was saying this yesterday, wasn't I, that we've had last week the Bund was in a very contained, tight range. We were being held by the 153 handle. We broke through that on Monday. We gapped higher yesterday as equities gapped lower. We had this phenomenal spike in the Bund down to those lows at about 8:30 a.m. yesterday. Quite a similar move to what I've seen recently actually in the Bund, where you do have these, you know, that's a 50 pip move and then very strongly rebounded. There's a lot of size going through on this Bund without it actually really going anywhere. But I think, you know, as long as the Bund's then within this range, we're oscillating now around the 153 handle, trade the ranges, don't expect the type of inverse correlation between the Bund and risk assets that you might normally use. There's more going on than that at the moment. The Bund just finding support at the pivot level. Guys, have a fantastic day. I look forward to working with you in the room. I hope the quality of the sound and the video sharing is good. We've upgraded, we've got our own direct fibers. Everything's been souped up. So I hope that's coming through clearly, and I look forward to working with you guys in the room. Take it easy.